How are you there? My name is Patrick Kamau Kamure, your teacher for taxation. Today we continue from our previous lesson, where in our previous lesson we were able to introduce ourselves to the taxation of the business income. And when we were looking at the taxation of the business income, we said here we want to see how various businesses which people do are subjected to tax. And I am very sure we analyzed those business and we said there are three. One is the sole proprietorship, the other one is the limited company, and the other one is the partnership. So what we have been doing in the previous lessons is that we have managed to show you some few things. One is how to determine the taxable income of any kind of a business, be it a sole proprietorship, be it a limited company, be it a partnership. How to determine the taxable income, where we talked about the two methods, the net profit method, the gross profit method. After we did that, we went ahead and we classified the incomes. We classified them into the taxable income and those ones that we call non-taxable income. And we say that the taxable income are the incomes that are supposed to be subjected to tax, and the non-taxable income, those are incomes which are not supposed to be subjected to tax. After we did that, we went ahead and we were able to classify the expenses, which we classified as allowable expenses, and also we classified them as non-allowable expenses, where we say that the allowable expenses, those are expenses that can be deducted against the taxable incomes of the business. Whereas non-allowable expenses, those are expenses that cannot be deducted against the taxable incomes of the business. Once we did that, there's another item that we looked at, the capital allowances. Now, capital allowance will help us now when we are computing the taxable incomes of this business. And we saw how you can be able to compute capital allowance, the various items that qualify for capital allowance, how to compute the capital allowance, the rates that you are supposed to apply, after which we also looked at the taxation of the investment income, whereby we said, if for example you have a business like now, a limited company, a sole proprietorship, or even a partnership, and it do happen to have another source of income, how are they subjected to tax? We were able to look at the dividend income, we were able to look at the interest income, we were able to look at the royalty income, consultancy fee, professional fee, how are they subjected to tax? Now, whatever we have been doing was laying the groundwork for now the taxation of those businesses specifically. Now here we go to those businesses specifically, and now we are going to start with the sole proprietorship. We introduce ourselves what is a sole proprietorship. Once we are able to tell what is a sole proprietorship, then how is it supposed to be taxed? So we will explain. Once we look at how it's supposed to be taxed, then we see how we look at a question on how to compute the tax practically. After that, we'll go to the partnership, and then we are going to finish with the limited company. So now we start, and as you can see in my board here, we have the taxation of the sole proprietorship, the first type of a business or form of a business. Now, first of all, we want to define what is a sole proprietorship. And right here on the definition of a sole proprietorship, we define it as it is a business owned by one person which is not registered as a limited company. That is the first thing that you need to know, that sole proprietorship is a business that is owned by one person, but that business is not registered as a limited company. Reason is, yes, you could be running a business as a one person, but you decide to go to the registrar of company and register it as a limited company. When it is a company, we are going to see how it is taxed under the company. But now here you don't register. That is a sole proprietorship business. Now, the second thing that we need to consider is, or in our definition, there's something that you're supposed to consider, that sole proprietorship is not considered to be a separate legal entity. from the owner. From the owner. Yes, when you're taxing the sole proprietorship or in the definition of the sole proprietorship, it is good to note that it is not considered to be a separate legal entity. What we mean by separate legal entity is that the business and the owner are considered to be one and the same thing. You don't separate the two. So that means that when you are taxing the sole proprietorship business, you tax the owner, not the business, the owner. What the owner is the owner of the business. Now, that is in the definition. Now, when it comes to the taxation of the sole proprietorship, we are going to look at things that you're supposed to consider before we look at a question. So, what are the things that you're supposed to consider when you are taxing a sole proprietorship business? So, items to consider. While taxing a sole proprietorship. Business. Now, we have only 3 items that I want you to note when you are taxing a sole proprietorship. Number 1, determination of the taxable income. So, how do you determine the taxable income of a sole proprietorship? We had said when you are starting on the taxation of the business, that any business is taxed on the taxable income. The taxable income is determined using either the gross profit method or the net profit method. So this one, it is determined using either gross profit method, let me write here, either number 1, gross profit method, or number 2, net profit method. This we already had looked at when we were looking at the introduction to the taxation of the business, that you can use the gross profit method to get the taxable income or a net profit method. So when you're dealing with the sole proprietorship, you use one of them to determine the taxable income, just like we talked about. That is number 1. We have number 2, determination of tax. It's called criteria of determining tax payable. So the question is, how do we determine the taxable income, the tax payable by a sole proprietorship? And when we talk of the tax payable, we mean this. We don't mean the taxable income. Taxable income is the income that is supposed to be charged tax, which you have said you use either gross profit or the net profit method. Now, once you determine the taxable income, our main objective is to determine the tax that is supposed to be payable by that sole proprietorship business, by the sole proprietor who we have said is the one who normally pay tax. So how do you determine, which criteria do we use to determine the tax to be paid? This is how we determine it. It is determined using graduated scale rates. Graduated scale rates, in bracket, taxed in the same way as a person or stroke an individual in employment. That is what you need to know. that when you're taxing a sole proprietorship business, once you determine the taxable income, you tax that person using the graduated scale rates. Graduated scale rates, you tax this person like an employed person, an individual who is under the employment. Where, if I can remind you, what you normally do is that the first, if we can use this scale rate of year 2022, and we're talking about the year of income of 2022 because that's the one that we are going to be using for the exam to be set in December 2023, then it means that for the first 288,000 per year, we tax at the rate of 10%. That's what we mean by graduated. And then the second 100,000, we tax at the rate of 25%. Anything in excess of 388, we tax at the rate of 30%. And that means that we also did give the personal relief to this person who is paying this tax, as well as the insurance relief to this person. And that's why I want to add something here, that once it is determined, once gross tax is determined, then I want to put this one here. Then the set-offs which include a personal relief, insurance relief, and withholding tax on investment incomes, are deducted from gross tax. Now that once you determine the gross tax that is payable after you graduate, make sure that you deduct these three items. They are called set-off, but we deduct them from the actual tax this person is supposed to pay. The first one is supposed to be the personal relief, the insurance relief, it goes up to here, and the withholding tax. I want to add here withholding tax on investment income, which is deducted from the gross tax. That is in the determination criteria of determining the tax payable. I told you there are three things that you need to know when you are taxing a sole proprietorship business. The first one is the determination of the taxable income. Once you determine, then you tax it. Now, there is the third one I want you to know. The third one, that any expense relating to the sole proprietor is a non-allowable expense, i.e. private expenses of sole proprietor. That you need to know that any expense relating to the sole proprietor is usually not allowable expense. It's usually treated and don't allow when you are determining the taxable income of that particular sole proprietor. And here we are majorly talking about the private expenses of the sole proprietor. They are usually not allowable when you're determining the taxable income. Now, having looked at that, at this moment, we can look at a question on how to tax a sole proprietor. So here is the question. I'll read and then I'm going to show you how the tax is usually determined.